Hello everyone, I'm Kyle Cheropita and this is The Upside. Today we'll be looking at a number of FidelityConnects highlights from February. Connects is first presented as a live webcast for financial professionals and then released on replay for all as a video podcast with new episodes dropping daily. So let's take a look at February's big stories, starting with Darren Lekkerkerker, portfolio manager of several Fidelity funds, including Fidelity North American Equity Class. In Darren's show, he touched on several opportunities he is seeing across North America, including tech, metals, and the banking space. Here he is with host Pamela Ritchie.
Tech companies largely are in the top 10 when you take a look at the North American Equity Fund, and I'm presuming that that will transfer into the American equity as well. This is a moment where the tech companies and large hyperscalers are becoming, in a lot of ways, owners of hard assets. And you've been running natural resources and sort of the material side of that for some time. This must be a rather perfect moment for you to launch into this, don't you think?
Well, certainly it is, because I was the mining analyst in Fidelity Boston in like the mid-2000s during the super cycle from China. And so I'm very happy that those stocks are having a moment, and they've been doing more than a moment. They've been crushing it. And it's kind of nice to be able to apply that skill to other companies as well. But I think one thing that's very interesting in tech this year is I think that there's more dispersion than normal. And I think what you're seeing is like software stocks down. I think that internet stocks have been mixed, like Google's done pretty good, but some of the other ones have been weak on par. And then hardware and semi stocks have done really well. So I think it's a different year than other years where you could simply index, like own the index or own like the top sort of momentum stocks and hope to do well. I think it's something where our skill, which is stock picking and our investment process, can become more valuable because there's more dispersion and a better opportunity to outperform the benchmark, which is our goal.
And yeah, this is, as you say, there's more stocks to look at. Would you call it a proper rotation at this stage?
Well, it's definitely been a rotation in the market. And so one of the things has been that we've seen a rotation towards early cyclical stocks. Why is that? I think people are getting a little more bullish on the economy. I think the economy was very soft. And I think particularly following if I go back to last April of last year when the tariff announcements came, people expected a recession. Now there's not a recession. And in fact, we're actually seeing growth starting to pick up. Why is that? Lower short-term rates. I think the Fed fund rates is about 75 bips to 100 bips lower on a one-year basis.
It's working its way through.
Yeah, we're starting to get we expect to get the budget stimulus for both consumers and businesses in the U.S. So I think you're seeing monetary and fiscal stimulus. And if you look at the Fed, Atlanta Fed GDP now CAS, which is the forecast of the next quarterly GDP, it's up to approximately 4% from sort of 3 or 2% last year. So I think because of that, you're seeing people rotate out of some of the growthier names that tend to be more expensive into the cheaper, more cyclical names that could see a benefit from a stronger economy. Still
big though, still large cap, still bigger companies for you.
That's right.
Yeah, you're not taking a look at sort of smaller companies.
I do own a little bit, but I would just say that the portfolio is more geared towards larger cap companies that I think are higher quality companies. And by that, what do I mean? I mean, I think they've got a great business. They've got a strong competitive moat that hopefully can increase over time. They've got a high or accelerating return on invested capital. And then just to review, I also look for strong management teams that have skin in the game, have executed well, really good at capital allocation, and I care about valuation too.
We started the month with a special guest, Richard Fadden, who is a current senior advisor at Capitol Hill Group, after previously spending decades as head of Canada's intelligence agency and key advisor to both prime ministers and to the civil service leadership. In his Connects appearance, Richard comments on the New World Order taking shape and addresses the question of how Canada brings together its human, technological, and geographic strengths to move confidently into this next era with a unified, crystal clear vision. Take a look.
You have a storied career resume. You have met with everyone that we've ever read about and lots of people that we haven't read about. Tell us a little bit about how you're interpreting this moment in time for our country.
Well, I think we're coming to a turning point, to use a phrase that the Prime Minister hasn't used yet. Turning point, though, implies that not absolutely everything from the past needs to be thrown away. But I do think the Prime Minister in his Davos speech hit the mark when he said that we are facing a brave new world. And it's not just because of the United States, which are causing a great deal of instability in the world, but China is increasingly assertive, in particular in Asia and a few other parts of the world. Russia is causing problems in many places. We tend to forget about terrorism. It remains a significant issue in large parts of the world. So fundamentally, it's less Canada, for the first time, relatively isolated because we're not under the umbrella of the United States, which, whether we like to admit it or not, I think allowed us to not make a lot of decisions because we were so closely attuned to the U.S., we sort of followed along. We did take some independent paths in the past. But I think now we're going to have to try and decide what kind of country we want to be, how are we going to prioritize that path, and forge new relationships, both with other countries, international institutions, but I also think forge a new relationship with the United States, because whether we like it or not, we cannot ignore the United States.
No, certainly. And do we need to know what the United States goals and game plan is first before we either create a plan for ourselves that somewhat reacts, but also offsets and complements?
No, I think that's right. Having said that, I don't think we can do that with absolute certainty because the current U.S. administration is rather inclined to shifts in policy in a very short term. So I think we have to accommodate the idea that there are a number of scenarios that are possible, and we have to build those scenarios so that we're ready to react to them. Having said that, I don't care if it's Mr. Trump or somebody else. We have stuff that the U.S. wants, both geopolitically and practically, and we have stuff that we want from them geopolitically and practically. And we're going to have to find some way of working amidst all of this. And I think if anything, the Prime Minister and the government are going to have to be fleet of foot and fleet of mind, because instability, I think, is certainly with us for 2026.
Mid-month, we were joined by Denise Chisholm, Director of Quantitative Market Strategy, who shared her thoughts on how investors, advisors, and companies are navigating disinflation, tech leadership, the CapEx story, and market breadth. Take a look.
You've mentioned in a recent report that inflation is an intensely, or inherently, I think you said, personal, what is it? It's a statistic that is personal? I guess that's right. Yeah. Experience. Totally. Why is
one of the most personal statistics that we have that the government releases? And it's partly because inflation, much like tariffs that we've talked about, always and everywhere, feels like a tax. If the prices that you are paying are going up, then that means you have, as a consumer, less purchasing power. So that's like step one that makes it very personal. The other part is the measurement issues around it. What is in my basket in terms of what I purchase might be very different from what's in your basket. So it never feels quite right when a national average statistics comes out as it reflects how you feel. Maybe some people, pay more money in terms of commuting to work. Maybe some people pay more in terms of healthcare insurance. Maybe some people have kids and pay more in terms of educational expenses. So it never feels quite right. And then you have a layer of a third option, which a lot of what the market focuses on is core inflation, meaning they strip out food and energy. So most of the questions that I get from clients are, well, wait a minute, I actually have to buy food and I drive to work, so I have to buy gasoline. Why would that not be included? And I think that that's a complicated personal view as well, where really the monetary policy impetus, why they look at inflation, is very different from how you and I think about the statistic overall, because it's how the Fed can influence inflation. It can't really always influence food inflation. It can't really always influence energy inflation because of supply-driven dynamics. So it focuses on what it can include. But at the end of the day, from a statistical perspective, the best you can hope for is never to fully reflect somebody's personal experience with what they interact the economy in terms of prices, but it is to say that the measurement is consistent over and over again, so we can look at a trend. And I think that gets back to a lot of the data being released over the last couple months, which is to say that despite the fact that many prices went up during tariffs, much of what we are seeing from a trend perspective is disinflation continuing.
I mean, it's very interesting because we'll bring in the spending that's going on in the economy as well, the CapEx story, as we mentioned, and so on. But the disinflation that's going on is coming from very high heights. I mean, we know this story from post-pandemic to soak up a lot of the money that was pushed out there via governments and so on. So we're sort of dropping from heights, and that's the disinflation. But the growth story seems very much intact from a lot of the different areas that we're looking at this. So I guess it's just sort of, there's a little bit of cognitive dissonance there. I wonder if you can take us through that, the disinflation plus growth.
Yeah, so there's two things. One, I would say most growth statistically, when you look back to 1962, is disinflationary. Meaning that if you had to bet on, let's just talk about industrial production or ISM recovering or even, real consumption growth accelerating, and you said, well, what usually happens to inflation? What usually happens to inflation is that it continues to decelerate. So I do think that there is still this knee-jerk reaction of any growth is inflationary that's statistically not viable, which highlights the issue we've been talking about for quite some time, which is inflation is much harder to get than people think. You don't just get it from growth. You usually get it from specific fiscal stimulus, and not all fiscal stimulus, right? We didn't see any inflation in the financial crisis when they spent $787 billion in a stimulus package, right? So not all stimulus is equal. But what we saw during COVID, 15% of stimulus on top of the economy, that was big enough. Right. So I think that there's still this fear that any kind of growth or stimulus or checks written by the government or rebates is going to lead to the same conclusion. And X that period where it was very large relative to any other experience, that's just usually not the case. So in some ways, again, going back to your base case, I'm looking for patterns in history. What should you bet on in terms of if there is a reacceleration in growth? I'd say you should bet on the disinflationary trend that we're seeing continue. But I think that there's a second part as well, which is to say the growth story is intact, sort of. Right? The growth story has been bifurcated. This entire cycle has been off cycle and driven by not a whole lot of areas in the economy. There hasn't been a broadening in terms of economic growth, right? You've had pockets of strength like CapEx and some parts of manufacturing, and then you've had deep pockets of weakness, the rest of manufacturing, small businesses, housing. You average the two together and you get average growth, right? 2% year-on-year GDP growth, which is mediocre at best. So we haven't really seen a substantial amount of growth. And in fact, manufacturing, industrial production, all the numbers that just came out are really emerging only now for the first time after a 3-year, I won't call it a recession anymore, but at least a malaise, which is you haven't seen growth for a sustained period of time that is very, very atypical in U.S. history. Usually you see, big drawdowns and big sort of ramps back up in terms of recovery, and we've just sort of been in this no man's land. Now we are finally emerging from that. I think that emergence is likely sticky when you look at it, and it's usually coupled with continued disinflation.
In February, Fidelity's global asset allocation team released their first white paper of 2026 titled 5 Questions into 2026. Capturing the most common and most pressing questions that they're hearing from investors. From renewed optimism around Canada to how AI is creating opportunity to whether the 60-40 portfolio still holds up. This paper connects today's big themes to what they mean for markets and for portfolios. Portfolio manager David Wolf joined Connects to discuss these questions and how GAA is translating them into portfolio strategy.
What about Canada? So Canada also is an area that was not of interest to you for, years and years at this point. It also had a fantastic year last year, but not everyone saw that right at the beginning of the year either.
Yeah, so there are a couple of things going in there. First, Pamela, as you know, maybe better than anyone, we had been underweight Canada for
as long as I've known you, however long
12 years.
Yeah.
I've been doing this, and we've had an underweight,
Yes.
and it's varied in size depending on the outlook, et cetera. But we said a couple of things. Number one, that the U.S. was less attractive, so we wanted to be more not in the U.S., of which Canada is obviously part. Number two, we have had a pretty large position in gold for a number of years,
Right.
mostly as a diversifier, but in this environment where people would be more concerned about dollar debasement, and we can talk about that
Yeah,
a
we'll
little
get
bit
into
further
that.
today.
That's part of it.
We knew that not only holding physical gold, which we do, but also buying back into Canada had leverage to the gold price more broadly, since Canada is a lot more concentrated in gold stocks than elsewhere, and that was a big story behind the TSX outperformance. And then the third
please.
was the Canada story itself, which is to say that you and I have talked over the years about we were kind of on a road to nowhere in terms of the economy, that housing was overdone, household debt was too high, productivity was stagnant, per capita GDP was coming down. So it was always going to end up kind of where we are now, which is the economy stagnant, housing market going down, et cetera. What we said several months ago was at least there's starting to be a path to better. And it had to do with policy reorienting towards the kind of thing that Canada's long needed to do, which is invest more infrastructure, break down interprovincial trade barriers, pipelines, seek out trade opportunities with countries other than the US, et cetera. We'll see how much that manifests itself going forward, but at least there's a path to better. And so given all those things, we said, we've been underweight for 12 years, we no longer want to be underweight, so we closed it.
So let's talk a little bit. I remember in the pandemic, you were talking a lot about, there's a huge upheaval of the supply and demand. We were talking about models not being adequate to measure what was going on. There was a repatriation of kind of everything, or at least you saw it coming. I don't know if it was happening at that time. How would you compare some of those, you can call them deglobalized, you can call them more localized, I don't know what you want to call it, but those trends, they're what we're talking about all the time now. Are they investable? How are you looking at that as an investment trend, if it is one?
Yeah, so there are so many things caught up in that, and we can kind of unpack them a little bit. I mean, one of the things to mention just writ large, geopolitics look really different today than they did during the pandemic. So that's going back, I guess, 5 years or so.
Yeah.
So you had, again, the US ascendant, so to speak, and yes, China, and then a couple of years later, you had Russia invading Ukraine, and it,
changed
that has sort of realigned the chessboard, so to speak.
Yeah.
But now it very much feels, and we have a political research service out of Boston that is a good source of intelligence for us. And what they've been talking about is the return to this kind of multipolar world, where you have the U.S. and then maybe a block in the Americas. You have Europe that seems to have been kind of, I'm looking for a diplomatic term, but like the U.S. doesn't seem to be as interested in supporting Europe as it was before, shall we say?
Canada does, but the U.S. doesn't. So the allies are changing a little bit.
Yeah, so all of the pieces are shifting around. That makes it more challenging for us because, we love it when markets are predictable, when we can just focus on economic growth and company earnings and inflation and policy and map that into expected returns in the various building blocks and then move money that way. When you have different and in many cases unpredictable policy from the political side, that makes things more challenging. But again, I mean, one of the decisions we took almost a year ago was to say, we don't know how this is going to work out, but it's probably not good for U.S. markets relative to the rest of the world. So let's be less in U.S. markets relative to the rest of the world.
We'll wrap up today with another clip of a special guest. Louis Tetu visited our Montreal studio mid-month for both a French and English webcast. Louis is executive chairman of Coveo, a Canadian-founded global AI software company. As we continue to navigate the evolving AI landscape and separate hype from long-term value, Louis made a clear distinction between efficiency and proficiency. Here is a highlight from that show.
You think of efficiency, and efficiencies often means things like layoffs because you need less people to do it. What do you mean by proficiency? I mean, I think we know what it means, but in this context.
Right. I think it's a way to think about the pre-AI period in technology and the post-AI period. And AI, that being said, has been in existence, for
a while now.
15 years. But generative AI in particular, made it very obvious, very tangible, very intuitive, as we all now have integrated in our daily lives. The world pre-AI, the world of software was essential, and no matter what it does, whether it's supply chain management or for financial advisors or CRM or ERP, anything, essentially you created a data model, you created a set of business rules, and then on top of that you have some sort of engagement layer that lets you manipulate the data, that lets you manage your workflows, and that lets you do your work and help But it was mostly, as you mentioned, Pamela, about efficiency, doing more of the same faster, more efficiently, more consistently. Comes AI, you're dealing with human augmentation, you're dealing with proficiency. So the ability of AI now is not to let you do more faster, but to let you, every individual, me and you, do more on your own. So if you think of that in terms of a bank, suddenly you have, let's say you have a bank with 10,000 workers, 10,000 employees. How about if every single one of these employees can suddenly process 50 or 30, 50, 100% more complexity on their own, 95% faster, 100% of the time? What happens when that happens? What happens when your customers, who have access to your products and services, but also can gather instantly, can stitch instantly a broader view of a theme, whether it's a vertical industry or a stock or whatever. What happens when these consumers suddenly are more educated? It raises the bar.
You've got
for
stronger
everyone.
soldiers
That's
for
right.
the CEO and management to work with. From there, what kind of problems can, for instance, a CEO trying to direct its company in arguably a changing world, what can they do with their stronger soldiers, for instance?
Well, I think they can serve customers better. Again, they can handle more complex projects. They can recuperate knowledge also in an incremental way. One of the fundamental issues of large and small organizations is that they tend to iterate, and it's very discontinued.
What's that mean, iterate and
well,
discontinued?
iterate and discontinued means sometimes the left arm doesn't know what the right arm is doing, and people tend to reinvent the wheel. Suddenly, you have an ability to constantly aggregate knowledge and learn from that and bring it to everyone's fingertips in real time. So the fundamental breakthrough that people are discovering about AI right now is that which is a novel capability, is that it can stitch fragments of information from anywhere and literally stitch them in real time and deliver them in a very tailored way.
In a report
I like the stitch and tailor analogy,
I like
so
that
people
too.
understand. But it will stitch that information and tailor it. Prior to that, we were in the software allowed you to retrieve existing information. The right information, we got really good at relevance over the years, with search engines and so on. But it was essentially retrieving and giving you, let's say, a document that already exists, or whatever the information you're looking at, a product or any kind of information, whether you want to learn something, buy something, fix something, it's always the same thing. It's the user's intent. Now with AI, you're literally stitching a novel. The result you get didn't exist anywhere. It's from fragments. It's called vectorized. It's what inference engines allow you to do. You vectorize information from multiple sources. So, number of corollaries. Number one, you don't need to move data anymore. So
that's interesting.
So for instance, Microsoft offers Copilot, but it's only in the Microsoft ecosystem.
Yes.
Salesforce offers Agentforce, but it's only you need to put all the data in Data Cloud and so on. What CIOs are realizing right now is that data can be assembled, can be stitched from anywhere. So it just exploded the world, and it creates a very horizontal landscape for the software industry, which is why there's so much angst right now about the siloed applications and the seed-based software companies and so on. I think some of it is exaggerated probably, but some of it is true also.
Thank you for tuning in today. So each of those clips was from a full 30-minute video podcast. Well, actually, both Richard Fadden and Louis Tetu were supersized 45-minute shows. And all full episodes are available on YouTube, Spotify, Apple Podcasts, and more. We are putting out fresh content daily, so for more from us, please look up Fidelity Connects or the Upside podcast. And the Upside, as you know, starts as a streamed webcast, and it's our public first show with the goal of simplifying investor content for all of you. Upsides are shorter, less technical, and more accessible content compared to the Connect show. So to not miss a live Upside, head to fidelity.ca and sign up for the next webcast. Thanks for watching today, and I hope you'll join us again on the Upside. I'm Kyle Cheropita. Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.